Chapter 20 deals with the federal neighborhood stabilization program. The cities and counties in California have been given over $500 million to purchase REO properties. That is a tremendous amount of money that is they're going to approach lenders and buy the same inventory that we are. Are they going to be our competitors? Will they beat us out of the inventory? Or is there a way that we can work together to where we can use our experience and save them money and profit, both of us? This chapter will talk about all of those things and also talk about the money that they were given. How much of that is really going to have an effect on our market? And one thing I'll tell you in advance is that I'm not afraid of their participation in any of our markets. I hope we do get to work with them, but they have very strict guidelines on how they're going to spend the money, and they have to spend the money. They have to commit how they're going to spend the money in the next 18 months or it gets taken away. So you can bet the next 18 months, the city and county entities are going to be very busy buying lender-owned properties. It's what they do with it after that that'll be very interesting. Our report will provide you the contact name, email, phone number of everyone that's in charge of how every dollar is spent for every city. So that won't be in the report, but it'll be on the information at our website. Chapter 21, California comeback number 2. So what happens next? We're going to have two very terrible years, I think, if you are on the wrong side of this real estate problem. Those types of things always bring about losers and winners. So this chapter will be talking about how to be a winner during this cycle. We expect to have a 13% interest rate during the next boom cycle. What this chapter is going to do is talk about how you have a comeback even though you have a double-digit interest rate. We have 5 proofs that we use to figure out what's next and how high the next boom will be. And we're going to show you what we think where we are in each of those categories. And what's interesting about this time is it is different. This is, as Alan Greenspan said, the 1 in 100-year event. This is where we're at. And that's why just looking at real estate statistics wasn't good enough to say this is how the California comeback number 2 plays out. Anybody that thinks we're at the California comeback already is sadly mistaken. So what do we do about that? And also, when we start going the other way, how high can we possibly get when we have a double-digit interest rate? Well, we've done a mathematical calculation for that. We have calculated rise in income, rise in interest rates to those significant levels, and a price increase. And we've basically mapped out for you how the next comeback will probably play out. So that's some exciting information. I'm very, very pleased, to be honest with you, to have done the report, but I'm also pleased that I'm done. I've read probably 10,000 pages of very technical reports on subjects that I'm not an expert at. This is my best shot at what I think is next, and I hope it's as accurate as our past reports have been. We'll be giving this report, obviously, January 31st. For those of you that are listening, I think you have until Wednesday the 21st to take advantage of the early bird special. We're close to 80% to 85% sold out already. So I would do that as soon as possible if you wanted to attend live. What we're now going to do is we'll take a look at the Chapter 1 of the Category 5 report, The Perfect Storm Matures. And we made 16 projections of what we thought was going to occur. And I think the most significant thing is to realize that this was done in 2006 while the market was still very positive and going up. And that's one of the things that you have to take a risk of doing when you do a report, is being willing to go against what's going on right now. It doesn't do us much good to tell us that in a report that California real estate is going to do bad if it's the first time you've ever said it in 2008. So we try to talk about things in advance before they're happening So as real estate investors, we can take advantage of what's next by making the correct decisions right now. So in 2006, we predicted that the United States economy would do better than that of California, and that is unfortunately the case even though the United States is doing very poorly. The unemployment rate for California is outpacing the U.S., and it usually does in a downturn, and this time I think we're going to get over the 12% mark, maybe into 13. So both the state and the country are actually having a tough time of it right now, but California is going to outpace the country in this downturn. The second thing we predicted were that interest rates were likely to rise, and again, from 2006, they did. They went up considerably. Adjustable loans that were subprimes, when they adjusted, the payments became a problem. And now they're back down again. So you have interest rates that will be very low for at least a year, maybe two. And will that help the resets? Sure will. The problem with the resets is that the equity has disappeared because of the downturn thus far. So that's going to be a problem. Interest rates are going to be mild for the next year or so, but it's what happens after them that's a big problem. And when all is said and done, all the government intervention, what kind of toll will that take on interest rates? The third prediction we made is that other investment choices would be superior to real estate. I think you'd have to say right now that to the public, the real estate is at the bottom of the barrel of choices, even though you've had a stock market get wiped out as well. Not too many people are signing up for a second and third rental at this point. They've been very damaged by what went on in real estate. So we were correct that real estate would really be, the rose would be off the bloom. And what happens there is that you lose people buying second homes, and you lose people buying rental homes, and spec buying dies, and foreign investors go away. All of that takes its toll on the volume of real estate that's sold. This downturn will have a very bad taste in people's mouth for a long time. And so real estate will suffer worse than other investments for a while. The fourth prediction that we made is that California would be the most expensive state when we were done. And in fact, that is what happened. So we're suffering the worst damage. We are now at the peak of the damage of price declines and for homeowners underwater. And so this trend is going to continue. In 2006, we were flying high, and to tell you that California was going to be a very big problem, most people didn't understand that that was possible, but it's now coming about. In 2006, we said migration would slow down and go negative, and that in fact has happened. In the chapter that we deal with migration, we'll show you the charts and the actual numbers for California. But that in fact did happen, and one of the catalysts for migration getting even worse is unemployment, and that's all about to happen. Chapter 6 is we predicted that we would have tighter lending policies, and we have that across the board. This is a chart from the California Association of Realtors showing the percentage of zero down payment buyers. And at the peak of the market in 2006, just virtually when we wrote this report, we were at 40% zero down payment. We are now closing in on less than 6% and headed down. Every lender is getting more conservative, and as these foreclosures mount, they'll get more conservative still.